All right, so last lecture on time value of money. This is where it gets a little more problem oriented, where you're having to kind of figure out, what do I need to solve for? How do I do that? I'm personally just going to use my time value of money calculator to solve everything. You could use an equation or you could use the tables. I do think they're more challenging, but you're more than welcome to do that. So let's kind of jump right in. So 49er Company issues a 6-year note to the bank. Under the terms of the note, 49er agrees to pay the lender $50,000 6 years from today. The note does not include any interest payments. The lender agrees to give 49er Company $36,262 in exchange for the note. So given that, what is the inferred interest rate? And so in each of these, you need to kind of map, what is the N, what is the I/Y, what is the PV, what is the payment, what is the FV? The first step, though, is to figure out what is it that I'm solving for. And in this case, I am solving for an inferred interest rate. So I know that I am trying to solve for the inferred interest rate. And so when I put everything into my TVM calculator, just sort of throwing it out there, I know that the N is 6, says that the payment is happening 6 years from now. I know that the end of 6 years, from 49er Company's perspective, I'll be making a payment of $50,000. That's why it's negative. The bank is giving me $36,262 today. There's no intervening payments in between. And so the inferred interest rate, then, the one that we are solving for, is 5.5%. 5.5%. Again, that's how we solve for some unknown. Again, it's what do I know? What's unknown? What am I trying to solve for? And then fill in the rest of the information to get the right answer. And so on the next one, we're saying, okay, 49er Company issues a series of bonds that will pay $500,000 when they mature at the end of 10 years. The bonds pay semi-annual interest. 49er Company receives $510,000 from the bond issuance. What interest payments must 49er Company make in order for the bond to yield 6% APR? All right, so a yield, just to be clear, the yield is the interest rate. So it's saying, okay, there will be an interest rate on this bond, an APR, an annual interest rate of 6%. And so when we go to solve for one of these, a couple of things get a little bit challenging. One is that it is a semi-annual interest payments. All right, so it's semi-annual interest payments. And so whatever we're going to solve for, when we solve for the payment, which is what we are trying to solve for, when we solve for payment, that's going to be a semi-annual payment. So if I want semi-annual payments, I've got to get everything else into semi-annual terms in order for this to solve correctly. And so when I talk about my N, I'm talking about the number of semi-annual periods. When I talk about my I/Y, I want the semi-annual rate. Now, the nice thing about PV and FV is there's no such thing as a semi-annual PV or FV. They just are what they are. It's a one-time lump sum. And so in this case, if we look at our information, again, pause it here, see if you can fill in as much as you can. But we have is our N is, if it's a 10-year bond, that means semi-annual would be 20. If the annual interest rate or annual yield is 6%, it means that the semi-annual yield is going to be half that, or 3%. And then we have to think about, what is the cash flow today and what will the cash flow be in the future? Well, when you issue a bond, just to kind of get you used to the terminology, what that means is I'm agreeing to pay $500,000 when the bond matures. So that is the future value of the bond. I'm going to pay it. That's money out of my pocket in the future. And then today, I'm going to receive $510,000. And so when I map all that out, you can see that my N is 20 semi-annual periods, a 3% semi-annual rate, positive cash flow today of $510,000, negative cash flow in the future of $500,000. And I want to know what payment will make all this work. And so you solve for the payment, and you get $15,672. And so that is the payment that this bond would need, given the other terms. Again, this, you can probably already sense, this is where time value of money becomes challenging, because you've got to figure out, what am I solving for in the context of one of these problems? All right, next one. Fortnite company must reserve enough cash to make a $125,000 equipment purchase 3 years from today. Fortnite company plans to set aside cash in a 7% APR interest-bearing account that compounds interest. Now, the key here, compounds interest monthly. The company plans to invest $2,000 at the end of each month throughout the 3-year period. How much must Fortnite company invest today in order to have enough to purchase the equipment in 3 years? All right, so essentially $2,000 a month is not going to get you there. All right, and so in addition to the $2,000 a month, how much do they have to put in the account today in order to get to $125,000? So we are solving for some amount that I'm going to have to invest today in order to get to $125,000. So again, pause, try to think through what everything needs to be, try to do it on your own as best you can, and then pick it back up when you're ready to go. Okay, so hopefully you took my advice and you did a pause and you tried to solve for this. All right, so essentially what we have to do is everything, because it says monthly, we need everything in terms of months. So much like the last problem, we needed everything in terms of a semi-annual sort of setting. Here we're looking at a monthly setting. And so if we want to know the N, really what we're asking is, what is the number of months? The I/Y, we're asking, what is the monthly interest rate? And then on the payment, what is the monthly payment? And of course, FV and PV are lump sums. There's really no monthly amount there. All right, so we know that they are making the $2,000 payments at the end of each month. And so we know this is an ordinary annuity, so I don't have to change any settings on my calculator, make sure that it's set to end. And now when I start putting the information in, I can see I know that in 3 years, they're going to be 36 months. 7% APR divided by 12 means I have a monthly interest rate of 0.5833. I know that I'm going to be making monthly payments, so I'm putting money into the account. And my hope is to withdraw $125,000 at the end of 36 months. So I hope to get out of that account $125,000. So hopefully that shows you why the payment is negative and why the future value is positive, because the cash flows are going in opposite directions. This is where you do need to really pay attention to the sign. So the payment being negative and the future value being positive is very important, because if you didn't do it, you would get an incorrect amount. All right, so when we solve for that, we know that we need to now set aside $36,612 today in order to have $125,000 at the end of 36 months, if I will also set aside $2,000 at the end of each month for those 36 months, and assuming that I have a 7% interest-bearing account where interest is compounded monthly. So you can see where this gets really complicated, and these problems can get very difficult. So you really need to review these. There are practice problems on Canvas as well. Go through those so that you can understand how to do this. And of course, the homework does more. And so hopefully through all of that, you start to get more comfortable with applying these to problems. All right, so another one. We've set aside $15 million in a pension fund for its employees. We plan to contribute another $1.5 million each quarter. Notice again, it says each quarter into the fund. The fund earns 6.75% APR, and interest is compounded quarterly. So now we were semi-annually, now we're monthly. We were monthly, now we're quarterly. All right. So if at the end of 10 years, how much are we going to have using this investment strategy? So again, everything needs to be now in terms of quarters. Now, the key, though, is it says that I'm going to contribute $1.5 million each quarter into the fund starting immediately. So this is an annuity due. And so what we want to know is, what is the future value of all of this? But there's really two things. There's the future value of the annuity, and there's the future value of the $15 million I'm putting into the account right now. The nice thing is your settings on your calculator for the present value doesn't matter, because it is today, it doesn't matter. But it does matter in terms of the annuity. So you got to tell it, hey, I'm going to make sure that I tell it payments are happening at the beginning of each quarter. So I have to change it to the beginning setting. Second payment, second enter. And so as I do that, I get my set this up. So N is the number of quarters, which hopefully, 10 years times 4 is 40. My I/Y, I need a quarterly rate. So I take my annual rate and divide it by 4. My PV is the amount that I'm putting in right now, which is the 15 million. And then the payment is the 1.5 million that I'm putting in each quarter. So I put all that information in. Again, 40 is my N, my quarterly interest rate, the amount that I'm putting in today, and then the amount that I'm putting in each quarter. And at the end of that 10-year period, or at the end of those 40 quarters, I will have $115.4 million. So again, the goal here hopefully is to understand the direction that we need to go, and hopefully we can get there. All right, a couple more of these. Example number 5. This might be the last one, I don't remember. All right, so we need $250 million in order to acquire a strategic partner. The company has established a fund that earns interest semi-annually. So again, paying attention to that semi-annually. The APR is 8.2%. So hopefully you can already figure out, okay, if the APR is 8.2, in your mind, you should already be thinking, what's the semi-annual rate? Hopefully you figure out that's 4.1. They want to make equal payments of $50 million into that, each one into each semi-annual period, and they want to start making those payments immediately. So they're going to put $50 million in each and every semi-annual period, and the payments are going to happen at the beginning of each semi-annual period. So again, ding, ding, ding. Remember, we got to set it to the beginning of the period. And so how many semi-annual periods is it going to take for them to reach that savings goal? How many times do they have to do that to reach $250 million? So again, hopefully you have in your mind that we're solving for N. So that's, that's the piece that we don't know. Sorry, we don't know the N. And so we're going to have to put in the I/Y, which hopefully you know that. The PV is the amount that we're putting in today if there is a separate lump sum. In this case, though, there is not a separate lump sum, because even the $50 million that we're putting in today, it's part of an ongoing payment. It's part of an annuity. And then we want to figure out, well, how much do we need at the end? Well, we need $250 million. So how much am I going to invest in order to receive $250 million in the future? And so looking at this, again, our I/Y is 4.1. There's no individual set aside lump sum today, so that's 0. The recurring payment is $50 million, knowing that we set it to BGN, and we're trying to grow it to 250. The end is 4.7. Or sorry, 4.47. So it tells us that it's going to take us 4.47 semi-annual periods before we're able to achieve our goal. So essentially what that means is I got to do this 4.5 times, right? But again, this was the last one. These problems hopefully are helpful. There are extra practice problems, I believe, on Canvas that will give you even more practice. I think there might even be a deferred annuity in there. But between everything, the homework, the examples we've done, you have more than enough to prepare you for the exam. But you need to work at it. You got to keep doing it, get that repetition up. For those of you that have me in class, you'll be watching a lot of this online, and then we will, of course, in class go and prepare ourselves for the test. All right. That's all for now. And hopefully this was helpful. Thanks.